If you're tired of guessing where the market is going, you're looking at the wrong time frame. Most traders fail because they get trapped in the noise of a 1-minute chart, but the algorithm follows a hidden time-based schedule. In this video, I will show you how to find the real draw on liquidity, how to spot the smooth traps retail traders fall for, and the exact times the algorithm activates. At the last part of this video, I will reveal the 930 no escape setup that guarantees you're on the right side of the volatility. Let's get started. Someone recently asked me a question that every trader struggles with. When the market is moving sideways, what are we actually looking for? Where is the draw on liquidity? Most people look at a small consolidation and try to trade the high and the low. That is a massive mistake. If you focus on that tiny range, your perspective is too narrow. You aren't going to do well in this game if you're just looking at the noise. To find the truth, you have to change your view. Stop staring at the 1-minute chart. Move up to at least the 15-minute time frame. Look for relative equal highs. On the 15-minute chart, the targets are obvious. These equal highs are areas where the market wants to go to clean up the price action. Before the 930 open, we are usually stuck in a small pre-market range. Think about it like this. If you could control the price, where would you send it? You would send it exactly where other traders have their stop losses. You want to take over their positions at the exact moment they are forced to quit with a loss. The market doesn't move randomly. It follows two rules. It seeks liquidity money. It reprices to fix inefficiencies. When you look at the charts from the perspective of maximum pain, everything becomes simpler. The path of least resistance is wherever the most traders will get hurt. This is why the 15-minute chart is my bellwether. It shows the algorithmic delivery that is hidden on lower time frames. Here is a secret about price delivery. Look for the difference between jagged and smooth edges. Jagged edges. This is where the market rips through liquidity. It's messy because doors are being kicked in and stops are being hit. Smooth edges. This is the trap. Retail traders see smooth highs and think it's resistance. They feel safe. They place their stop losses right above those smooth lines. But if it looks smooth, you can bet the algorithm is going to run right through it. It's like a SWAT team waiting to bust the door down. The market makes it look safe to entice you to go short. Then, it uses your stop loss as fuel to go higher. So, how do we use this logic? It all comes down to a time delivery schedule. Price runs aren't just about levels. They are about the clock. Time is the most important principle in trading. Even if the economic calendar says there is no high-impact news, it doesn't matter. The algorithm activates at specific times regardless of the news. 8:30 a.m., the engine starts. The market begins moving toward the liquidity pool. 9:30 a.m., the no escape zone. This is when the real volatility kicks in. We shouldn't be surprised when the market explodes at 9:30 and runs through the lunch hour. It has targets to reach on the daily chart. At 8:30, it starts the journey. At 9:30, it finishes the job by taking out everyone who was trapped in the pre-market range. If you can align your bias with these time windows and the 15-minute draws on liquidity, you stop guessing and start following the smart money. To wrap this up, let's solidify the core narrative you need to carry into every session. Remember, the market is not a random collection of price bars. It is a liquidity-seeking engine running on a strict time-based schedule. Number 1. The bellwether rule. Stop squinting at the 1-minute chart during consolidations. Zoom out to the 15-minute time frame to identify the real draw on liquidity. Look for those relative equal highs or lows. Those are the magnets the algorithm is aiming for. Number 2. The smooth trap. If the price action looks clean and uniform, it's a setup. Retail traders see resistance, but smart money sees fuel. The algorithm will purposely leave smooth edges to entice shorts, only to kick the door in and run those stops to reach its true objective. Number 3. The power of the clock. Price moves because the time tells it to. Whether it's the 8:30 a.m. engine start or the 9:30 a.m. no escape volatility, the algorithm operates on a heartbeat. When you stop trading patterns and start trading narrative and time, you stop being the liquidity and start following the smart money. Use the 15-minute chart to find the target, and use the macro windows to time your entry. That's it, traders. Thank you for watching. I hope this explanation delivered greater clarity and practical insight that you can apply to your own trading. Make sure to subscribe and turn on notifications so you never miss future content. Leave your questions and suggestions in the comments section below. We truly appreciate your support, and we look forward to seeing you in the next episode.